Hello and welcome. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the fourth quarter 2021 review. As always, we'll have two videos, a short one just to get the highlights and a longer version of the video where we show you our work, if you will, or our charts that went into some of the conclusions that we're going to share with you. As always, you can pause, speed up, or slow down your video player to suit your needs. Thanks again for watching. So let's get started with the performance highlights. We're going to zoom in here real quick on the performance of the accounts, or the different markets, I should say. And if we start with the Canadian markets, we are looking at a fantastic performance. So for 2021, the TSX total return, so that would be dividends as well as price appreciation, is up 25.1%. The S&P 500 in Canadian terms is up 27%. And so these are the closing levels, by the way, 21,000 on the S&P TSX, 47, almost 4,800 in the S&P 500. The NASDAQ had a good year. Obviously, 21% or almost 21% is nothing to sneeze at. And then Europe had a decent year. Europe was up another 13%. And the laggards, if you will, in the markets were the emerging markets, predominantly led, if you will, if I can use that, on the downside by the Chinese markets. The bond markets also had a negative year. So for those of us that use bonds, for those investors that will use bonds as a shelter or a safe harbor, it's very rare that we'll see negative returns, but we saw them this year, and largely on the back of rising interest rates. And in the longer video, I'll show you a lot of work that goes into showing you what happened to interest rates and why they rose. Oil had a fantastic year. We're looking at a swing from $48.52 at the end of 2020 all the way up to $75 at the end of December of last year. But the past quarter, oil prices didn't do very much. Gold prices were more or less flat. Interest rates are moving up. So on a GIC side, you can get almost 2.25% for a 5-year GIC, which is right around what inflation seems to be. I should say the long-term rate of inflation of around 2.5% to 3%. The Government of Canada bonds, you're looking at a 5-year number of 1.25%, a 20-year bond. So you lend money or buy a bond issued by the Government of Canada, and you're looking at making 1.65 or locking in 1.65% for the next 20 years. Let's look at our performance attribution. So we've got the US markets on top, and we've got the Canadian markets on the bottom row here. So we've got 4 panels. I'll start at the upper right. Those are the 505 members. It basically tracks the performance of the 500 members of the S&P 500. And what I'm trying to show you here, two things. One, some of these fantastic returns from the top performing stocks and the bottom ones as well. What's interesting here, there's a couple of themes you can sort of hone in on. A stock that had been dead money for basically a decade, something like Ford Motor Corporation, on the back of its electric vehicle build out, or plans to build out, I should say, had a fantastic year. And we have some oil companies, and Moderna, which is obviously in the middle of a pandemic, will do very well, a retailer, and chip stocks, as well as a steel company. On the downside, it's fairly focused on companies that are, it's fairly broad, if you will. You've got some themes here that you can tell in terms of Penn National Gaming, which would be gambling, which would be tied to, and which was one of the best performing stocks the previous year. So a bit of a get back there. And you've got Las Vegas Sands and Wynn Resorts, which are tied to travel. So it's fairly broad name here. What's interesting, or what we like to show you every quarter, is the difference between the top 5 stocks of the S&P 500 and how they carry the index or not. So in terms of the meaningful performance, the upper 5, the stocks, so those would be Apple, Microsoft, Google, Amazon, what we used to refer to as Facebook, now Meta. So those names represented a large part of the performance. In fact, 30% of the advance can be explained by those 5 stocks. The Canadian markets is a slightly different story. The performance differential, which is the bottom one, I know it's negative here, it looks pretty big, but it's just the scale. But really, the top one here, not a whole lot of difference between the top 60 stocks and the broad indices. So that's, to me anyway, a sign of a healthy market. Whereas in the US, when you have a large discrepancy here between the top stocks, the top 5 giving you 30% and 495 stocks giving you 26, that's it's a significant difference. And that means that there's a lot of stocks underneath in the index that didn't perform very well. That's what it means. And back to the Canadian story, energy dominated the best performing stocks by and large, with some absolutely fantastic numbers, shooting the lights out. But remember, a lot of these stocks were down 80, 90%. So it looks fantastic, but if you sort of drew out the stock charts over a 5-year period, those stocks, depending on when you entered them, you still might be underwater. On the worst performing stocks, gold, as we know, was flat on the in terms of the underlying commodity price, but the gold price index, if you will, of gold producers didn't do very well. And then we have sort of the cannabis sector not doing so well, and other sort of past fantastic names or top performers in Aurora and Lightspeed and Ballard and Canopy Growth. Those were all stocks that had done very well 3-5 years ago, even up to 2 years ago. So is it a situation of a give back? Time will tell. So let's look at 22 and beyond in terms of what are we looking for. As we move forward, we want to take some time here and review the broader investment strategies. Regardless of your portfolio manager that you've chosen here at Exponent, these strategies are all-encompassing, if you will. So the first step that we look at are the secular trends. So those are the multi-year trends, pandemic, no pandemic. These are the prevailing winds, that, as I like to call them, that will last a very long time and have a dramatic influence on the economy and on certain industries. So once we've identified those secular trends, so we'll give examples in the longer version of what that looks like, in the longer version of the video, we then drill it down one level and talk about exposures. What kind of industries are going to be exposed to these secular trends? How do we want those exposures to be made? Do we want to own companies that are directly exposed to the trends, or do we want to look at second and third derivatives? And finally, the bias. We tend to like companies that have a certain risk reward, a certain balance sheet, a certain history. In my personal case, I prefer companies that have a dividend history, an ability to reward their shareholders. So those are the way that we invest money here at Exponent. It's really a 3-prong or a 3-step approach. Secular trends, then drill down to the kinds of exposures we want to have, and then how we want to have those exposures in terms of what kind of bias do we tend to prefer. That's it. Thank you very much for watching the shorter video. If you want to stay on and click on the longer version of the quarterly reports, we'll go through a lot of interesting charts. I'm Benoit for Exponent Investment Management.